The following is a production of Texas Lutheran University. For more information, please visit tlu.edu.
Well, welcome everybody. I think that we have much better weather today than we did last Friday. So thank you for making time in your plans to come out and join us in support of the Bulldog Investment Challenge and the Bulldog Investment Company Internship. Your support is very much appreciated. I cannot tell you the amount of time, effort, and hard work that goes into the students' presentations that make this all happen. They're really some of the smartest, most dedicated kids that I could ever want to know in my life, and I can promise you that you being here today is extremely appreciated. My name is Dave Sather. I'm a proud 1989 TLU graduate, and my firm, Sather Financial Group, we are a private wealth management firm. We sponsor Bulldog Investment Company as well as the Bulldog Investment Challenge. Today our firm manages about $360 million, and I'm very proud to say that 50% of our firm is TLU graduates. So I absolutely love the fact that I can show up here on a Friday afternoon and pick off your best and your brightest. Since the beginning of our firm, the premise of why we do what we do has been based in how Warren Buffett operates day in and day out. So we all probably have a common understanding Warren Buffett's a really rich guy. However, I think it is far more important to understand that he's a very successful businessman and investor, and he has such ethical standards that show that success in the business world and ethical behavior are not mutually exclusive. In fact, they go hand in hand. That is something that we try to display in our firm, and this is something that we try to share with the students so that they can understand you can be good in business and not have to be a complete criminal. Maybe the rest of the guys on Wall Street will figure that out one of these days too. So the strategies for running Bulldog Investment Company, they are very much predicated on the way Warren Buffett operates Berkshire Hathaway day in and day out. I figure if it's good enough for the way that we manage real money, it's definitely good enough as a teaching tool for all of them. Additionally, this is not a simulation. A lot of schools have programs of this nature, but they are simulations. They basically say, well, we would have placed this trade, or theoretically we placed that trade. These guys are dealing with real money. That is very, very unique for a school like TLU. Your finest MBA programs all have programs of that nature. However, that's University of Texas, Texas A&M, Harvard, programs like that. TLU being an undergraduate program and using real money at a school this size is very unique. From our perspective, it allows our students to walk out the door as graduates and compete with anybody from any university and compete for jobs and truly make a meaningful impact on the very first day. So I said students manage real money. Today their portfolio is north of $200,000. They all take it very, very seriously. Many people often have the misperception that all the students that are going to come through this program are going to be investment managers. That's actually not the case. Even though I pick off a few of them and a few others have gone into the field of investment management, every student that comes through here, even if they're a theology major, they're going to end up working for an organization that produces financial statements. Financial statements and the ability to read them will tell you whether or not you're going to work for a company that is on the verge of bankruptcy or a company that is just extremely stout, very well run, and that you're working for honest, ethical people. That is a skill set that is very valuable to anybody. I don't care who you are. Since we do manage real money, I'm guessing a natural question would be, well, how exactly have these students done? We started the program in the fall of 2009, and since then, their portfolio has compounded at a rate greater than 20% a year. Last year, they did better than 34%. If they were professional money managers, that would put them in the top 1% of all money managers in the world. It's not bad from a bunch of undergraduate kids. Our program is open to all students. Naturally, we have some business majors. However, we also have kinesiology majors, psychology majors, information systems, economics, psychology. It's open to anybody who wants to work hard and think in a critical manner. The things that we do are not difficult. They just require some work. So, if you are interested, come see me. We meet every Friday here in Lower Shapey Hall. Every afternoon we meet for about 2 hours. It is very worthwhile. all these fine students who are here in coat and tie, looking sharp as ever, ask them about the program if you're interested. For today, we have two teams, and this is very indicative of the way that our program operates month in and month out. But for one presentation a semester, we want to open it up to a broader audience so you guys can really see what goes on here. Each of these teams has to show that the company that they have researched is consistent and predictable, much like Warren Buffett would, and then show that they actually understand the company. Buffett has always said, if it's not consistent and it's not predictable, you have no hope of being able to value the business. And ultimately, in the long run, that's what the students have to do, is place a financial value, be able to show that they understand the current value of the business and that they're able to buy it at a discount. The presentations today will be 45 minutes in length. I understand for some of us, that might be a bit long to sit in a chair. So we will have a 10-minute intermission in between the first and second presentations. There's a group of esteemed judges up front that are going to be judging, and they will have the opportunity to ask about 15 minutes worth of questions after each presentation. So I'm sure you guys are wondering, other than bragging rights, what's on the line today? These students show up, they can get credit, but probably 80 to 90% of them show up just because they like the intellectual challenge. Most of our students don't even get credit for this program, even though they could. But maybe to give them a little bit of incentive, there's $10,000 on the line today in scholarship money. I can promise you they were very upset when I talked to them last Saturday that they did not get to present a week ago. I am hoping that that anxiety has turned into even more excitement about presenting today. So that said, I thank you all for being here, and I'd like to turn it over to our first team.
How's everybody doing? We are the Berkshire Hathaways, and we're going to be presenting on IBM today. My name is Ernest Stevenson. I'm a junior from Hitchcock, Texas. I'm a double major in economics and math. This is my 4th semester in Bulldog Investment Company.
My name is Jacob Bravo. I'm from Houston, Texas. I'm a senior information systems major, and this is my 3rd semester in Bulldog.
I'm Eli Baumberger. I'm from San Antonio, Texas. I'm a junior business economics major, and this is my 2nd semester in Bulldog Investment Company.
I'm Kelly Gomer. I'm from Yorktown, Texas. I'm a business management major. I'm a junior, and this is my 3rd semester in Bulldog Investment Company.
My name is Tasha Phillips. I'm a sophomore accounting major. I'm from Goliad, Texas, and this is my 2nd semester in Bulldog.
So even though IBM does compete in the technology industry, I like to think of them more as an innovation company. IBM is continually transforming to higher value for their clients, which no other company does as well as IBM. They're continually remixing the higher value in their portfolio and their skills, which is a very important process that we'll talk about later. And IBM's management is continually remixing the higher value in the operations of their management practices, which is Warren Buffett's main reason for investing so heavily in the company.
Okay, so to start off, just a little company background. 3 companies came together in 1911 to form the Computing Tabulating Recording Company, which was then later named International Business Machines Corporation in 1924. In 1973, IBM released its first automated teller machine, and in 1981, they produced their first personal computer. The 90s saw the rise of the server, and IBM was a leader in sales and services for the server industry. About a decade later, IBM began to shift its business focus from the servers and the hardware to more of a service-based and consulting solutions industry, business. In 2012, IBM was awarded the most patents of any company for the 20th consecutive year, illustrating how successful they have been at innovating throughout the years. Okay, so in more recent news, last Wednesday, the 4th quarter earnings came out, and yes, IBM did miss its predicted 4th quarter earnings. And as a direct result of this, the top executives for IBM announced that they were going to forego their end-of-the-year bonuses, which constituted between 17 and 27% of their actual annual salaries. Another thing they announced that they're IBM suffered a dip in revenues in China throughout 2013, and part of that was due to the fact that China announced its economic reform plan, and some people are fearful of what that could mean for the Chinese economy in the future. Another part of that is IBM saw some of the fallout from the NSA scandal this past year, and currently they're being sued by a sheriff's department in Louisiana based upon the fact that they did not they did not announce that it was a risk that their PRISM software was reporting to the NSA on information of foreign citizens. On a more positive note, Lenovo agreed to buy IBM's low-end server business, the x86 process servers, last Thursday for $2.3 billion. IBM also announced that they're committed to investing $1.2 billion in SoftLayer, which is a recent acquisition near the end of 2013. This will double SoftLayer's cloud hosting abilities and give IBM a stronger foothold in the cloud computing market. IBM also invested $1 billion into Watson as a business unit, and Jason's going to tell you a little bit more about that now.
Okay. Well, now that you've heard where IBM comes from and who they are, let me tell you a little bit about what they do. Their business model is set on two principles. The first is to help clients become more efficient, more competitive, and more innovative. The second, which we're very excited about as long-term investors, is they really put a large emphasis on long-term return to shareholders. So IBM's business, it can be a little complicated, but you can break it down into 5 major segments. The first segment is split into 2. This is the global services. And that is global tech services and global business services. Their third is software. And their fourth is systems and technology. And finally, their smallest segment is global financing. So the first of the global services is global technology services. And IBM is an IT integration company. So in information technology, there's the technology side and there's the business side. So the global technology services are their services and consulting on the technology side. What they do is they provide infrastructure and integrate it, and they also deliver business value through global scale, standardization, and automation. There are several capabilities to their global technology services, including the outsourcing, processing services for companies, and also maintenance. Their next global service is global business service, and it is exactly how it sounds. They are consulting to businesses through the information, through the technology that they provide. So they're helping businesses become more efficient and more competitive through their consulting of the technology that they provide to those businesses. Their third and highest margin segment is software. IBM offers several software segments, most of them including middleware, which is software that communicates with the application layer and the operating system. I'm trying not to get too technical, but they also do operating systems. So there are many capabilities from security software to database software, and then also, of course, operating systems. And their fourth segment, systems and technologies, is the lower margin segment, or the segment that is declining in margins that they're trying to steer away from. This is their mainframe segment where this comes into play, the systems and storage. As Eli told you, they recently sold off their x86 low-end servers. They still maintain their System Z servers, but they also have a lot of solutions through this segment, so they still have some higher margin profits running through this systems and technology segment. Finally, there's global financing, which is their smallest segment. This is basically just helping clients who acquire IBM services or systems finance, and they make a pretty nice profit for that. So we split up the revenue by segment so you can see where exactly they're making most of their money. So I'll start with global financing. In 2007, global financing was around 2.5%. In 2012, 5 years later, it decreased to almost a little below 2%. There's systems and technology, which is the area of the segment they're trying to move out of. In 2007, it was a little less than 22%, and then 5 years later, it was down to 17% flat. There's software, which in 2015, IBM has said that they want to make 50% of their revenue. In 2007, it was 20.4%, and then in 2012, it was a little lower than 25%, so about 4% increase. Their global business services remained relatively stable, 18.42% in 2007 to 17.86% in 2012. And then finally, their largest segment, their global tech services, has increased 2% from 36.86% to 38.7% in 2012. And so when I say that they're shifting to larger margins or growing margin areas, this is what I mean. Their global services margins in 2007 were about 30% and 23.5% respectively. And in 2012, that increased 7% and 6.5% respectively. Their software, which is the highest margin segment of theirs, and what they're really trying to move towards, because that's where the profits are. They had 85.2% in 2007 and 88.7% in 2012. Their systems and technology and global financing segments aren't increasing in margins. In fact, they're slightly declining, but in 5 years, they've maintained relatively stable. So we're really excited about IBM because a lot of people have been talking about them being a dead company or old tech, and they're not going to be able to grow in the future. They won't be able to sell anymore again. They've missed revenues for 7 quarters, and there's no growth anymore. IBM has several growth initiatives, and they're all very exciting, and they're all things as investors that we look for in a company, a plan that they're looking to pursue. Their first growth initiative is Smarter Planet, which is divided into smarter commerce and smarter cities. Their second are growth markets. They've been investing a lot in growth markets, especially Africa. The third is business analytics and optimization, which is led by Watson, the supercomputer. And then the fourth is the cloud computing sector, which is the emerging sector in the technology industry. And that is split into the private and public, respectively, smart cloud and software. So I'll get into those right now. So Smarter Planet, I'm sure a lot of you have heard of Smarter Planet, seen the commercials. Essentially what it is IBM is using technology and analytics and information, and they're combining it to make decisions, informed decisions that will help companies and public governments anticipate and tackle challenges they wouldn't be able to without that information. So basically it's split up into Smarter Commerce, which is the private sector. They help businesses make more informed decisions through analytics. And then their public sector, Smarter Cities, they help local government. So an example of what Smarter Planet would do with Smarter Cities is, let's say here in Seguin, we want to make the traffic more efficient, because sometimes the stoplights aren't synced, right? So we want to make the traffic more efficient. Well, IBM will come in, they'll analyze, they'll take the data and say, look, this is the most efficient timing for your stoplights, and this is going to be the best traffic movement for your city. That's what they do. They solve problems. Now Watson, I don't know if any of you have heard of Watson, but it won Jeopardy in 2011, which is really an accomplishment for a computer, because Jeopardy is filled with puns and figures of speech, and computers are very logical, so it's difficult to tell a computer a pun and it understand exactly what you're trying to ask. But Watson is a cognitive supercomputer capable of understanding natural language and remembering context. It's really crazy when you think about a computer, because I could talk to this computer, it can spit out a relevant answer, whereas if you go into Google, you have to type in a bunch of keywords, and all it does is just spit out pages matching those keywords. It doesn't really understand context. But they are expecting a lot of profit out of Watson, and they're very excited about it. They have 2 major industries that it's been working in. In healthcare, Watson has been helping the Sloan Kettering Cancer Medical Center diagnose patients. And the beautiful thing about Watson is that it's cognitive. It's able to learn. So the more that you teach it, the more that you feed into it, the smarter it gets, the better its decisions gets, and the more effective of a machine it becomes, which is very exciting. They're so confident they invested $1 billion into Watson for a new business unit to continue to teach it, to continue to split it up into different machines. So we have a Watson for healthcare, we have a Watson for finance, and we also have a platform for other companies to use Watson technology to create startup companies, which we can receive revenue from as well. IBM has projected revenue of $1 billion in 2018, so a return on their initial investment. And then in 2023, 5 short years later, they expect a tenfold on that investment. And then finally, cloud computing is their last growth initiative, and this is sort of a buzzword in the technology industry right now. Everybody's concerned about cloud computing, and this should be. It's the emerging market, and it's going to offer a lot of revenue and profit for companies who have a strong foothold in it. Now, instead of competing against Amazon and Microsoft in the low-end commodity of cloud computing, where they're battling dollar for dollar, IBM would rather sell software and sell solutions through their cloud hosts. And so they acquired software. In 2011, 2012, and they've gained $1 billion in revenue in 2012 from software, and they also gained a lot They host over 270,000 more clients than Amazon does through software.
Okay, so now to address some of the risk factors that the technology industry is subject to. You have your general technology risks, such as not acquiring the correct intellectual property licensing, or the fear of cybersecurity and internet privacy. There's the general business risks, such as economic fluctuations in the economic environment that could lead to cuts in IT spending, as we've seen earlier, not meeting their productivity objectives, and possibly damaged relationships with their suppliers or distributors that could inhibit them from serving their clients. There's personal risk. Like any company, you're going to depend on employees with skills, and as those employees leave, your skills are leaving with them. Acquisitions risk, if you don't meet the objectives set out in your acquisitions and mergers, that could negatively affect the company. And now back to Jake.
Right, so many companies in this industry face similar risks, and I just want to show you some of the companies that IBM competes against in their different segments. So in their global services, they mainly compete with Accenture, Computer Sciences Corporation, Fujitsu, Hewlett-Packard. In their software segment, they compete with Computer Associates Inc., Microsoft, and Oracle, which are two large competitors for them in several segments. In their systems and technology, which again is their low-end servers and systems storage, they have Cisco, Dell, EMC Corporation, once again Hewlett-Packard and Oracle, and then of course Amazon in the cloud front. And then their global financing, of course, they compete with certain financial institutions, but relative to their technology industry, they compete with Cisco and Hewlett-Packard. So what protects IBM in the short term against these competitors and against the many risks they face? Well, these are their competitive advantages, which are short-term advantages that protect our company. The first is their ability to acquire, and specifically Aspera. Aspera is the company that IBM acquired that delivers the fastest transmission of files speeds over any network link, regardless of distance or file size. So to just give you a glimpse of what this means for IBM, for a 2 gigabyte video, which let's just say is about 3 minutes long, if you wanted to transmit it here to Maine, it would take about 3.5 hours to transmit a file of that size. Well, with Aspera's patented technology, it takes less than 5 minutes. And that's a competitive advantage. Also, their next competitive advantages is their acquisition of software and software. So I mentioned how Microsoft and Amazon are duking it out dollar for dollar in the low-end commodity selling of cloud hosting. Well, IBM doesn't want to be a commodity salesperson in cloud hosting. They want to be non-commodity. They want to sell software, and they want to get high margins through those software. So in 2014, they're planning to launch over 100 cloud products and 40 cloud services through their software hosts, through their software clients. And then finally, their short-term advantage is incentivized management in the workforce. Eli mentioned how their management forego their year-end bonuses, which range from 17% to 27% of their annual salary. Now, I don't know about y'all, but if I'm in management and I'm losing 17% to 27% because I didn't do what I was supposed to do, I'm definitely going to get in gear and make some changes that will pursue my principal goals of providing long-term growth to my shareholders. So, but as long-term investors, we need to also look at the long term. And so IBM has several long-term protections, which we call the moat, the protected moat. First is the barriers to entry. IBM is a large company, and they provide several barriers to entry when it comes to competing with them in the technology industry. The first is the largest mathematics department of any public company. When a growth initiative of yours is business analytics, you definitely want a lot of PhDs in your corner to come up with the next patented algorithms and the best analytics in the world. The second is the research and development operations, which they invest over $6 billion annually. And through their patents, which they've been the leader in the world for 20 consecutive years, they receive about $1 billion of patent licensing annually. So not only is that a long-term advantage, because 20 years is definitely what I would consider sustained, they also come up with great things from their research and development, such as Watson, or the ATM. Finally, IBM is a very sticky business. And what I mean by that is, if you are a customer of IBM, you're likely to stay a customer of IBM. You're going to keep coming back and keep opening your wallet. Why? Because there's high switching costs. When you work with IBM, it's very personalized and it's very reliable. So if you want to go to another provider to get more solutions, they're not going to be able to pick up where IBM left off. They're going to have to start all over, and that is cost to you, the client. Secondly, IBM is built as a three-pronged provider. They provide hardware, software, and services that are all integrated. They're designed to work together in the most efficient manner. So that keeps customers, if a customer goes to buy hardware from IBM, they're going to want to get the software there too. And if they need services for their software or hardware, they're going to want to go back to IBM because they know how it's designed and they know how it works best. And finally, what that causes is relationships. And when you have relationships with the customer, you're going to come back. So to simplify it further, basically what IBM does is they manufacture and sell computer hardware and software. They offer consulting services, they solve problems, and they innovate technology. Now, I'm going to hand it over to Kelly, who will tell you about the quantitative attractiveness of IBM.
Thank you, Jake. Okay, so I'm going to go through a few qualitative as well as quantitative reviews here, starting with some financial analysis with the interpretation of financial statements. So the column on your left-hand side is the ratios that we have calculated for IBM. The center column is our thresholds and where we would like to see their numbers either above or below. And the furthest right-hand column, one closest to me, is basically pass-fail, whether they meet the requirements or not. And as you can see, IBM
So here we have the DuPont analysis of IBM against 6 competitors in Amazon, Microsoft, Cisco, HP, Oracle, and Accenture. All the way to the right, you can see the return on equity for each company. And as Kelly said, that is Warren Buffett's favorite ratio. And you can see that IBM does have a much higher return on equity than all of its competitors. But there are certain ways that ROE can be manipulated and it can be deceiving. So what we do with the DuPont analysis is we break it up into 3 parts to see where a company is deriving their return on equity from and their strengths and weaknesses in doing so. All the way to the left, you can see the total asset turnover, which shows how efficient a company is being in turning its assets into revenues. And IBM has a total asset turnover of 0.86, which is the 4th highest, so there is room to improve in their asset turnover. Next, you see the net profit margin, which shows how much of a company's revenues they're turning into earnings. IBM has a 16% net profit margin, which is above our threshold and much higher than HP and Amazon, which have virtually non-existent profit margins. But there is room to improve as they are the 3rd highest in this group. And next, we see the financial leverage multiplier, which IBM does have the highest value, have the highest number for this category, because as Kelly said, IBM has been putting on more debt to finance their assets. So this number is higher, but all of our debt is payable within 3 years of net income, so we're not worried about this number. And even if you were to cut their financial leverage multiplier in half, we'd still have a return on equity of over 40%, which is still great. So here I have a comparison of some key financial info against those same 6 competitors. And what I did was for each category, we have the green is the highest or the best value, depending on high or low, and then the red is the worst value in that category. So on the top line, we can see market cap, which just shows the size of the company. As Drake said, IBM is a massive company, and they're second in this group only to Microsoft. Next, we have return on equity, which IBM does have the highest return on equity, and then their return on assets, which is the 3rd highest in this group. Next, we have gross profit and net profit margin, which are about in the middle of the pack of this group. But as Kelly said, IBM is continually improving their margins, and that's something that we would really like to see. Next, IBM does pay a much higher dividend than any of these other competitors, but it is still below our dividend payout ratio of 60%, so there is still room to increase that. Finally, you see price to earnings and price to sales, which show the value of a company, and IBM is about in the middle of the pack. I think they're 2nd and 3rd lowest in those valuations, respectively, and the lower the number, the more shows a buying opportunity. So next we have the conscious investor reports. And what these do is they take past earnings per share and sales per share numbers, and they project those numbers going forward to predict the return on our investment if we were to invest at this current price. So first we'll look at the 3-year numbers. And with an earnings per share growth of 11.69%, with almost 100% stability rating, which shows how stable and predictable these ratings are, or these predictions are, with a sales per share growth of 7.24% with about 98% stability rating, then we can expect to come out with a 13.84% return on our investment. So next we'll look at the 6-year default, which does the same thing but looking at the past 6 years of growth rates. So with this, we look at a 14.5% earnings growth rate and a 5.75% sales per share growth rate with about 97% stability for each. And with that, we can expect a even better, 16.7% return on our investment. So finally, we're going to look at the 10-year default. So looking at the past 10 years earnings growth of 15.3% and sales per share growth of 6.7% with about 96% stability, we can expect even better 17.5% return on our investment. So here we try to build in a safety model and show in worst case scenario what would happen to IBM and how they would fare. So with that, we cut the price to earnings down by 13% to 11.61, and we cut the earnings growth by 59% down to 6% growth, and with that we can still expect a 4.23% return on our investment. So now we try to kill the company, try to make it even worse, see what happens. For this, we cut the price to earnings down another 5% to 11, and we cut the earnings growth down another 17% to 5% growth, and with that we can still come out on top with a 2.18% return on investment. Finally, we see how bad everything would have to happen. What would have to happen to IBM for us to break even on our investment? For that, we cut the price to earnings down another 11% to 9.82, and with that, we would break even on our investment. So here I do a similar thing to the guru focus. And what this does is it lets you plug in a growth rate for the company, and it grows the company at that rate going forward for the specified time period, and then it discounts those cash flows coming back with the discount rate because future value is worth less than present value because of opportunity costs. So then, with that, we plug in one of IBM's lowest growth rates, their 5-year earnings before interest, taxes, depreciation, and amortization growth of 9.6%. With that, we get a fair value of about $215 and a 17% margin of safety. So now we try to see how slow IBM will have to grow for us to break even. And for that, we plug in 6.56% growth rate, which is near the very bottom of what they've ever grown at, and that gives us a 0% margin of safety. So now what I'm going to do is, we've talked about their debt, and so I'm going to look at their debt, and over the next 2 slides what I have is I have IBM's, all of their debt listed based on maturity date from 2014 all the way to 2096. So what I did was I boxed in some of their highest amounts of, the largest amounts of debt to show when they're coming due, and you see that the largest amounts of debt aren't coming due until 2017, 2018, 2020, so in the next few years. So IBM, here is a graph that's showing the same thing. It's just a little easier to visualize, a little easier to see. And what you have is you have the maturity rate going across the bottom from the left to right on the debt. From bottom to top, you have the interest rate on that debt, and then the bubble size represents the amount of the debt. So as you can see, we've said that IBM has been issuing new debt, and they've been doing this, they're locking in the investor-friendly climate right now. They're locking in low interest rates on this debt so that they'll have to pay back less later. And across the board, you can see that. And I know this does look scary because it does look like a lot of their debt is, majority of the debt is coming due before 2019, but IBM does have a great relationship. There's a large company and very stable, and they can restructure this debt with financiers if it needs to be done. But as Kelly said, all of their debt can be paid off within 3 years of net income. So with the majority of their debt coming due within the next 5 years, that doesn't really worry us. Okay. So now I'm going to look at the valuation of IBM against the current companies that we own in Bulldog Investment Company. What these valuations do is show you the value of a company, and we look at these when we're trying to determine whether a company, it's a good time to buy a company. And the lower the better, it shows that they're at a lower price. So price to earnings is one of the metrics that we look at, and for that, IBM has the 3rd lowest price to earnings in our portfolio besides AIG warrants, not counting AIG warrants and Best Buy because they don't produce earnings. And this just shows how cheap IBM is. Okay, so price to sales is another metric we look at. It's about the middle of the pack of our portfolio. It's not a great discount, but still average value. Price to free cash flow is another metric that shows how cheap IBM is compared to the rest of our portfolio, as they are the 6th lowest in our current portfolio. And finally, the 52-week price range is what we're really excited to get in this company. And their main metric we're looking at show how cheap it is. As you can see, IBM is closer to its 52-week low than any other company in our portfolio. That's why we're really excited to get in at this price. So what I did was I looked at the valuation ratios of IBM against the rest of our portfolio. Now what Tasha's going to do is look at the valuations of IBM against itself through the past 15 years to show you where it stands at today.
Thanks, Ernie. So just like Ernie said, Vandenberg metrics show the value of the company relative to its past 15 years. Now all these metrics are going to be in graphs, and generally we like to buy in when they're at its lowest because that means it's a discount to us. We're first going to start with price to earnings. Just like Ernie showed before, it's at a lower than its 15-year average. This red line going across, that is its 15-year average. So when it's lower than that, it's at a discount to us. Price to free cash flow, as you can see, is right at its 15-year average. That's still fair value, and that's still where we like to get in Bulldog.
So to recap why we want to invest in IBM. IBM gets constant production from their research and development department. As Jake said, they invest $6 billion annually in their research and development, and they continue to be one of the top innovators in the world. IBM is a very sticky business. There's very high switching costs for customers. With IBM's three-pronged approach of hardware, software, and services, it's very convenient to go to IBM for all of your problems instead of having to go to multiple businesses. As Kelly showed, IBM easily surpasses all of Buffett's financial requirements. It's a great financially sound company. IBM has a very strong brand name. There's lots of loyalty that goes along with this. When you think of IBM, you think of a company that's been around for over 100 years and that's survived through it all the changes in technology. IBM, as Jake said, they're very keen on providing value to their shareholders. And they plan to give $70 billion back to shareholders in their 2015 roadmap, with $50 billion of that being in stock repurchases and $20 billion of that being in dividends. IBM is a very innovative company that's poised for the long run, and as Tosh said, they are selling at a reasonable discount to their fair value.
So as we look at IBM and they're missing their revenues for the past 7 quarters, it's really easy to say, well, this company's done, and not dig a layer deeper. But when you look at all the factors that played into them having one of the largest consecutive revenue misses in their history, it really starts to make more sense. And you really start to look at the long term and say, I don't think many of these are going to last. First is the devaluation of the yen in Japan and China's economic reform combined with the fallout from the NSA scandal. This all played a major factor in IBM losing 22% of revenues in the Asian market. Also, you must consider their shifting business model. As the company becomes dynamic and starts changing, you can expect revenue losses before they really hit their stride. Finally, when you saw the 15-year revenues, you could tell that it was a little cyclical. A lot of this has to do with what's known as the mainframe investment cycle, and right now it's at its valley. Essentially, in their systems and technology segment, specifically in their System Z mainframes, customers don't buy them every year, and IBM is right now at its valley where it's about to come out with a new System Z mainframe where we can expect a lot more revenue, and that valley will start to become the peak. And then finally, a relatively new CEO, Virginia Romney, came in as CEO in 2012. And that obviously has a lot of challenges with that, and then as she gets more comfortable as a leader and gets past the 2015 roadmap where she starts to guide the company herself, we'll see some long-term changes. You combine all this together, and you have a perfect storm that has hit IBM right now, and we're very excited to get it while the market is devaluing.
So, as Jake said, there's been a lot of doubt surrounding IBM lately. A lot of people saying the company is doomed. But we see this kind of overreaction in the market all the time. But as long-term investors, we're able to look past this media frenzy and really take the time to look into the financials of the company and what's really going on. Not many people do that, but we did, and we've just shown you that we think IBM is a great investment. So that reminds us of a Warren Buffett quote that says, "Be fearful when others are greedy, and greedy only when others are fearful." That's why we believe it's time to get greedy with IBM, and we represent a limit order. We recommend a limit order of IBM at $176.70 a share. We are the Berkshire Hathaway. We'd like to thank everyone for their time, and thanks, Dave, for this opportunity.
Judges, fire away.
Jacob, you did a good job explaining a complex company. I think you could have taken even a little more time because I believe that you understand the material pretty in-depth level, but you did a great job explaining it. You talked about the cloud profit margins, and I think you did a good job differentiating between how IBM's different from a Microsoft who's in a commoditized cloud business. What do you think the potential margins are for cloud profits, though, for IBM, who's trying to get into a higher margin?
Well, I mean, a lot of they're offering over 100 software products through the cloud. So when you look at their software margins, it's around 80 to 85%. So that's what I would expect for their software margin, because it's just going through a different medium. It would go through systems and storage such as their mainframes, but now it's just going to the cloud. So I would expect similar margins, about 80, 85%. And then also with their services, that can range anywhere from 37 to 40%.
Okay. You also talked about Aspera, a company they recently acquired. How does IBM plan to monetize
for Aspera, they basically are planning to offer it through their solution. So a lot of globalized companies will make great use of Aspera because they're going to be wanting to unify their company. So let's say that you have a company and you're stationed in Texas, but you also have an office in Japan or something. You want to share a large file. You're doing a project or something. This really makes everything a lot more efficient. So instead of waiting 3.5 hours to do work with each other to combine, you can just do it in less than 5 minutes, transfer large files of that size. So I see it as really a value to enterprise businesses that work on a global or larger scale.
Eli, you said that IBM plans on laying off X number of jobs recently. That's just, it is what it is. That's what they've announced. Do you know what department they're laying off of? Who's being impacted by that layoff?
It's probably going to be in the systems and tech segment where they're trying to reduce. That's where they have most of their losses. I'm assuming that's where they're going to reduce a lot of their workforce.
Okay. Because you had identified their math department as being a competitive advantage. I just wanted to make sure that that competitive advantage wasn't being diminished by a layoff.
Yes, yes. Well, also, and they're also selling off the huge portion in the x86 process. So I mean, they're going to be missing those.
Related to that.
Okay.
Ernie, when you had the Conscious Investor software pulled up, you said that you use that to you take past earnings and you factor in the growth rates to project, forward what earnings are going to be. So my question is, on your first slide, you had something that said, "We pursue continuous transformation." That's what the company does.
Yes.
So if a company is continuously transforming and reinventing itself, how can you tell us what they will be doing in 10 years? And if you can't, how can you confidently project out earnings in order to value the company?
Well, I think those were very fair estimates. As I'm saying, that IBM is consistently moving to higher value. They're getting into software. Software, will bring up revenues. So I think, I don't know about earnings as much, but with revenues, I think those are fair estimates. So I think it would even just be a lowball estimate with revenues. With the past, even if you're looking at the 3-year numbers, the past 2 years, revenues have been falling. So revenue per share growth rates, that wouldn't be very high. So I think moving out of the valley and moving into more software where we have higher margins, I think those are low estimates. So I mean, I think they're fair. I think
When you have a company in the technology market, there's always going to be some evolution and some changes. But when you look at the quantitative part of IBM, you can see that it's consistent, it's predictable, and that's really what we look at. IBM knows how to get those numbers, and they know that they're in a dynamic industry, so they're going to find ways to keep growing those numbers and keep improving it. So it doesn't concern us too much exactly what they're doing, as long as they're doing what they need to do to stay on that roadmap of consistency and progress.
Jacob, I have a specific question for you. You talked about Watson, a supercomputer. I don't know much about technology, but from what I know, technology continuously becomes cheaper, and people, from what I've heard about supercomputers, they become obsolete very quick. Whereas someone else can build the same supercomputer for cheaper and do it quicker over time. So, what do you feel is the future for Watson? You talked about what Watson did in 2011. As time passes, does the Watson supercomputer become obsolete as technology becomes cheaper for other companies?
I don't think that the Watson computer will become obsolete because you have to consider that IBM is also going to continue innovating and continue progressing. Watson builds off of decades of IBM's personal research. There's a lot of stuff there that's simply theirs. As far as I know, nobody else is working on cognitive supercomputers. And then also they already have a lot of plans to do exactly what you say, which is improve and make IBM cheaper, faster, and smarter. They've introduced their research and development of Watson 2.0, which will be able to process images. So instead of just analyzing big data and text, it'll be able to take an image of, say, when you take the Sloan Kettering Medical Center, of a tumor cell and diagnose properly. And then also Watson 3.0, which they have a separate research and development team working on, will be able to debate and reason. So, I mean, I think IBM really understands the fast pace of technology and how it's ever increasing. But I think that they have the ability and the innovation and the capabilities, as a along with the financial backing to continue to stay ahead of the curve, especially when they're lots in the forefront.
Dave, I have a question for you. Go back to your point about them being a fairly sticky business, given where their revenues have fallen short the last 7 quarters. Do you think their pricing is as sticky as their customer log? I guess the question I'm having is, are they having a lot of success holding their customers, but maybe not on the pricing side?
I think that they are having a lot of success holding customers. As you can see, that their backlog continues to increase year over year. So they are keeping customers and they're gaining more business from customers. The pricing, I'm not so certain about. I think a lot of what has to do with their revenue declines has been in the basically the perfect storm, which I talked about. I don't know if they're going to continue to put as much emphasis on their Asian market, and if so, with the China economic reform, if they're going to have to reduce prices to maintain a busy foothold over there. But they are increasing. I don't think it's the customer. They're increasing their backlog, so they are gaining more customers year over year. I hope that answers your question.
Another question I had, when we looked at the 15-year averages in terms of our price to earnings, did you look at any shorter time frames? The reason I ask is in that 15-year period, we had some very high valuations in 99, 2000, 2001. And then, so what did that look like in shorter?
Well, with some of them, with those average lines, we looked at the price to free cash flow slide, as we showed, it was below its 15-year average. But with that one per se, because I do agree that back then, 98, 2001, there are some higher valuations, but none of them were as bad as the price to free cash flow. The price to free cash flow ratio from 98 to 2001 was ridiculous. I mean, we don't expect IBM to be trading at those kind of ratios again. So we actually took that into account when we put the red line in there for the 15-year average. So if you look at that 15-year average line, which it was right at its 15-year average, that wasn't actually including price free cash flow of 70 and 80, which it's been trading at 20 and 15 for the past since 2001. So we took that into account there, and that's why we put that average one in there. And then some of them, if you look, it's about price to earnings is fair about the past 5 years. It's been trading around 13, 14, 15 when it's at now, instead of at the 15-year average of 18, because there are some price earnings of 20 in there, 22. But for the past 5 years, it's still about at the lower end on price to earnings, which is one of the main ones we look at. And then price to sales is a little overvalued, and it wasn't too bad. It's been trading at low 2 to mid 2, so it wasn't too bad. We took that, so yes, a little bit into account when we did some of those slides.
You guys spent a lot of time talking about the leverage of IBM, talking about the financial impact that they are broad users of leverage. And you made great strides in explaining that all of their long-term obligations could be paid off in 2.88 years of earnings. Why does that matter? Give your audience a real-world explanation of why that is important.
So in hard economic times, like the recession that we saw a few years back, a lot of trust is gone. A lot of these banks, a lot of these financial institutions start coming due, and they start saying, hey, you need to pay me. I let you borrow this money, you've got to pay me now. So when we see a company, we're trying to present to you, Apple or someone, or just some company, and we told you that, oh yeah, it's taking 20 years to pay off their debt with their net income. Well, that's pretty scary, because that says whenever in a 2007-2009 recession, when that 2-3 year period when banks are starting to ask for their money back, that means that company doesn't have the money. They don't have the net income to pay those debts off. But when we show you a company like IBM that can pay their debt off in 2.88 years, and that's including everything. That's including not just their long-term debt, which is a number we're given, but pensions, pension shortfall, long-term leases times 7, and whether they have preferred stock or not. So it shows us that within 3 years, they're able to pay off all their debt. So with a huge company like IBM, it may look like, oh, they have so much debt. All this debt is coming due before 2019, but they're able within 3 years of net income to pay that off. So it's just kind of a security blanket of kind of that you can know that when times do hit hard, that IBM is not going to be affected as badly. There's going to be no bankruptcies.
you quoted a variety of valuation ratios, and you talked about, I believe you showed that price to sales and enterprise value to revenue were at some of their highest levels in the last 10 or 15 years. How does that affect your thinking? Why do those ratios matter, or why don't they matter?
Well, with price to sales, price to sales and enterprise value, you said the revenue?
Yes.
With both of those, recently, so you have enterprise value over revenue for one of the ratios he's talking about. The other one, you have price of the company over sales, which is revenue. So with IBM's, as I said, the mainframe investment cycle in the last 7 quarters, their revenues, their sales have been decreasing. That these two ratios we don't see as important as say price to earnings, because earnings is what we look at IBM we think is more consistent with what they're doing. Or some of the other ones, price to free cash flow. So when we look at those, if their revenues have been going down, that's giving them a lower number on the denominator, which is making the ratio higher. And so that's why it's been at one of its higher values recently, is because of the dip in sales.
You guys have shown me a company that is shrinking by many arguments. You've got folks like Stan Druckenmiller, one of the greatest hedge fund managers ever, who is openly shorting the company. He is betting against you guys. He's also betting against Warren Buffett, so consider the source. However, in y'all's assessment, how do you argue against the drop in revenues and sales for IBM relative to increasing earnings per share, increasing free cash flow per share? I mean, a lot of people will argue that this is just a product of financial engineering. This has all been attributed to what? You tell me, and then you tell me whether or not it's fair.
Okay. First of all, before we get into that, I should say, as far as like Stan Druckenmiller and those things, Druckenmiller might be right. Druckenmiller and Warren Buffett don't have to be right or wrong. Druckenmiller is a short-term investor, and what he's saying about the company couldn't be right now. The company's stock price is dropping. It's been dropping for a couple of years. Since we were supposed to present last Friday, it's dropped a couple dollars, and we're excited to get into it at a cheaper price. So for Druckenmiller, Druckenmiller doesn't want to be holding the company right now, because in the next 2 weeks, it might drop another $1, another $2, another $3. But with Warren Buffett, and with what we do, as Dave said at Bulldog Investment Company, we're long-term investors. And then we believe that IBM will continue to grow and continue to increase. And they are getting smaller because they're trying to figure out, they're growing in some segments, they're decreasing in other segments. So it's kind of, like we said, they're in a shift right now. And so for the financial engineering, yes, earnings per share might look a little juiced right now, free cash flow per share with a decreased amount of shares, but IBM is not just meeting earnings per share numbers, they met their earnings. They've been meeting their earnings total. They met this last quarter, as Eli said, they did miss revenues, but they did meet their earnings estimates. They were expected to grow at this percentage, and they did grow at that percentage. So yes, some of the number earnings per share, sales per share, those might look a little off because of the huge amount of shares IBM has been buying back, but they've also met their earnings estimates as a total.
On a related note, how is IBM meeting its earnings? You said they're increasing their margins, yet their revenues are decreasing. How is that possible?
They're decreasing their cost of goods, so they're basically becoming more efficient. So, I mean, when in the hardware and the commodity, it takes a lot to, the cost of the goods is higher relative to the price you could sell it at, because it's more competitive and it's commodity based. So what IBM is doing selling software, basically the cost of the goods are lower relative to what they can sell it at. So that's how they maintain earnings without increasing earnings.
Kelly, you stated that IBM pays a higher dividend than its competitors. What did you mean by that? And how does that thinking go into how you think about the company and how you evaluate whether or not you want to invest in it?
Well, when on the competitor side, like when we compared it to like Microsoft and Oracle and a few of the others, like IBM's dividend, I think the last year was like over $3.50, and the other companies it wasn't even meeting $1. So it is significantly higher. Is the only thing I
in your discounted cash flow analysis, there was one scenario in which you ran one scenario that produced a 0% margin of safety. What does that mean?
Okay, whenever in the discounted cash flow model, I don't know how, I know it's, I think it's the current stock price minus, that would be the projected stock price at that growth rate minus the current stock price
You tell me.
over the current stock price. What I'm saying, what it's showing you is showing like a gap. If you were to invest at this price and it grows to that price, how? I don't know. I think I'm pretty 50%. 50% that it's projected minus current over current.
A 0% margin of safety means you're paying fair value.
Yeah, paying fair value. That one we would break even. Fair value.
Jacob, you talked about patents that IBM is able to get, and I think on the slide that you had, I think what you showed is that they invested $6 billion in R&D just last year alone. But I think you also said they only got $1 billion worth of patents. And so, to me, that doesn't sound like a very good return on investment. So how do you think about that? Is that just a necessary cost of doing business in technology, or how do you think about that in terms of the money that IBM is investing for you?
Well, no, I mean, I think if you can get $1 billion just on licensing your patents, that's awesome. You know, because that $6 billion they invest in R&D is for all the other revenue that they're getting. It's for all the technology segments that they're investing and having to constantly innovate in. So no, they're getting much larger returns on their R&D in their other segments and their other revenues and their profits. And $1 billion in licensing patents is just, it's icing.
Thank you very much. Why don't we give them a round of applause?
All right, guys, again, I'd like to thank you all for coming out and spending your Friday afternoon with us. I know there's other ways you could be spending it, but we appreciate you being here. It means a lot to me and my group. So what does it mean to be a value investor? What it means is sometimes you pick a company that's not that sexy. It means you pick a company with strong financials, a company that's consistent, predictable, and very, very easy to understand. C.H. Robinson is a third-party logistics company. We will clearly outline what they do, how long they've been doing it, why they're the best at what they do, what their competitive advantages are, how they're a financially strong and stable company, and why right now is the time to invest in a company like C.H. Robinson. I'll pass it over to Emily, who will introduce us all and talk a little bit about the background.
We have renamed ourselves Not So Risky Business. Hopefully you take us up on that. But this is Nathan Ramos, Leon Wagner. You just heard from Arthur Munoz. Stephanie Thompson is here on my left, and I'm Emily Crow. And I'm going to start us off with the interesting stuff. So who is C.H. Robinson? We already heard from Arthur. It's one of the largest third-party logistics companies in the world. It actually is the third in the world. It's first in the United States. It's publicly traded on the NASDAQ. They develop global transportation and distribution networks, and they've been doing it for over 100 years, and they have 61 subsidiaries around the world. So this it looks really complicated. I promise you it's really not. It's basically just reiterated what I just told you. We're first in the U.S. It shows you that we're the largest. And all that this bunch of text is saying, you don't have to take the time to read it. I'm just going to tell you. All it's saying is that they're a long-term strategic partner that continually provides high levels of service. They're efficient, and they're very focused on their customer base and their carriers and fostering those relationships. The mission statement is, our people, processes, and technology improve the world's transportations and supply chains, delivering exceptional value to our customers and suppliers. They continue to expand on that, and we're going to show you how. So, as I said, they've been around for over 100 years. I'm not going to go through every little thing that's ever happened in C.H. Robinson. You probably would not forgive me for that when we got out at midnight, as Dave said. However, a lot of it is acquisitions. The big things I'm going to point out to you on
this slide is that in 1990 they started using air cargo services, and those have been growing. We're going to talk about that later. Can you next slide, please? And the important thing is on this slide, again, more acquisitions, they're growing, and they acquired Phoenix in 2012, which is an international freight forwarder that's headquartered in Illinois, and that only helps grow the business. And in 2012, they also introduced Navisphere, the company's proprietary single technology platform, as you can see. Nathan's going to talk about that later. They also sold T-Check, which is their payment services, and you'll see a little bit more on that in a minute. So when you think of transportation, there's a couple of ways that you can move something from one place to another. The majority of what C.H. Robinson does is contract trucking companies. So trucking less than truckload, which is when you have like smaller shipments that don't necessarily make a full truckload. However, it's more efficient to have multiple things, and like if you have multiple purchases in one truckload, it's a little bit more efficient just to carpool those. And if you have to pick up someone along the way, save a little bit of gas, and you keep your truck full so it doesn't get empty, a little bit more money in their pocket. They're also using ocean and air services, which are continually growing, and intermodal, which is essentially between those forms of transportation. And their logistics. You can see everything up here. The big things I'm going to focus on this is that they reduce and eliminate supply chain inefficiencies. They're an extremely efficient company. It's what they do. It's what they focus on. C.H. Robinson is not very complicated. And they minimize storage time, which is exceptionally important for things like produce, because you really don't want your strawberries to sit in a warehouse for 3 weeks before you get to them. Probably would be happy about that. And they're very open with their lines of communication between those. Sourcing actually has a lot more to do with those things like produce. Moving things from one place to another. You saw in the history slide that in the early 1900s they had those refrigerated trucks where they didn't just have to stick them on ice for hours and expect them to be good. So those services have only gotten better. It's what they've been doing for over 50 years at least now. And they do very well keeping those lines of communication open between those suppliers and those carriers to make sure that these things get to those places very well. You're going to treat things like produce a little bit differently than if you're shipping bricks and lumber. So this is very important. Their revenues, I talked about them selling T-Check. This is part of the reason. It was less than 0.5% of their revenues. Over 85% of them actually come from transportation, and it's what they do. Again, this is a very simple company. And this is their net income. 74% of it, as I said, most of it is trucking. 74%, or 3/4 of the company, is dealing with those truck carriers. As you can see, everything else has been growing. It is a fairly large portion of it, of the rest of the 25%. But ocean and air especially have grown in the past couple of years. Air by 80% and ocean by 300 or 150. Sorry, cut that in half. 150%. These are the global control towers. This is how they make those big decisions from those different areas of the world. They actually just added another office in Austria 3 days ago, but the main towers are in Chicago, Amsterdam, Mumbai, and Shanghai, and they cater to 3 countries in North America, 4 in South America, 14 in Europe, and 11 in Asia. These branches are spread out because it hedges against inflation, and it spreads out the risk of catastrophic loss due to some freak natural disaster that can just wipe out a chain somewhere and not somewhere else in the world.
All right, well, I'm Nathan. I'm going to talk a little bit more about the background. To begin, we're going to start with the employees. First off, the growth of C.H. Robinson is a lot to do with the acquisitions it has, and a big problem with that is the integration it has into the company. One way they combated this was by centralized training for new hires, and it just helps us to assimilate them into the culture of C.H. Robinson. The compensation is performance-based. Basically, it gives incentives to the employees to work harder and better, and possibly earn a promotion within our company. On this slide, I want to emphasize right here. It says the top 500 customers are 50% of our net revenue. Basically, the customers that do come to us or to C.H. Robinson are sticking with them, and they're continuing to come back. And also, we're not having to hunt for other largest customer is only less than 2% of our net revenue. So if we do lose any of our customers, it's not a big hit on our net revenue. C.H. Robinson is a third-party, non-asset-based logistics company. So we have very few assets on the books. And we have, basically what we do is work through a lot of our transport providers. And we want to stress that it's diverse. 82% of our truckload shipments are like mom and pop shops, like companies with under 100 tractors. So these are companies who can't advertise or market their company as well as the bigger companies. So they come to us when they're trying to look for business to ship and to move supplies. Technology is an important part to C.H. Robinson. The Navisphere is a software that only C.H. Robinson has. It basically makes it easier to match suppliers and shippers together across the world while being more efficient, so you don't have to have empty truckloads where you're losing money without shipping. They also made it easier with a mobile application for Android and iOS phones, so it's just more compatible and easier for customers and clients. All right. Now we're going to talk about the risk factors. When looking at a company to invest, a recession is always a problem. It's something you can't really do much about. You just gotta basically hope for the best. Carrier prices for our carriers, if they rise, then we have to pay them more, and we lose our net profit or net revenue margin. And the logistics industry is very easy to get into. There's low barriers, so we're facing a lot of other industry or a lot of other logistics companies, and that's bad for us because we don't want a lot of competition. But we are like a good brand name, the first in North America, the largest logistics company in North America, and to point out on the Navisphere, we are relying on our technology. And the fuel costs we'll talk about more a little bit on the next slide. Well, the fuel costs we pay for the carriers are part of like how we make, or how C.H. Robinson makes money. So if we can pay them less for the fuel, it'll raise our net profit margin. I just want to say that the natural gas is a good opportunity for us to reap some benefit without any risk because we're not the ones converting the engines. Now, the company goals for C.H. Robinson, the company goals long-term compounded growth of 15% in C.H. Robinson's net revenues, the income from operations, and the earnings. The internal growth, they want to expand throughout with new customers and then more relationships with our current customers. And they also want to try and expand in air, through the air and then on the ocean. And the augmented growth, it's just acquiring, and they've already started to do that. In 2012, they've acquired Phoenix. That's about it. All right. On this one, it just shows the Guru Holdings who are part of C.H. Robinson, or who have C.H. Robinson. And we're making a decision we don't base solely on who has it, but it isn't bad to be in the company of Donald Yachman.
I'm Stephanie Thompson, and I'm going to talk about the competitive advantages. Here in Bulldog Investment Company, one of our biggest concerns is finding a company that has a sustainable competitive advantage. These competitive advantages fortify a company against competitors by giving them characteristics that competing firms can't emulate. With C.H. Robinson having low barrier, or with the industry that C.H. Robinson is in, having low barriers to entry, as Nate talked about earlier, it's imperative that they have strong competitive advantages. C.H. Robinson is the largest third-party logistics company in North America, and
and the third largest in the world. With this large scale, they're able to offer their customers, many options when looking at their portfolio of services. Even though they have this large scale of operations, their decentralized structure allows them to make intimate and long-lasting relationships with their consumer base. Technology such as the Nanosphere, which Nate and Emily both mentioned earlier, allows them to connect instantly with their shippers and suppliers. This makes their company more efficient. This all leads to the network effect, which if you think about Facebook, as more people join Facebook, the better the service becomes. Likewise, when more people come into C.H. Robinson, the more likely someone's truck is going to be filled, and it snowballs from there. In addition to competitive advantage, Bulldog Investment Company also likes to take a quantitative look at the company we are thinking about investing in. We get our metrics from Warren Buffett, and he uses these as well to see if the company he's looking at is actually a great one. You'll notice here that our gross profit margin, in addition to our net profit margin on the next slide, both do not meet our threshold, but given the industry and that it is a low margin industry, that's okay. And as Arthur will talk about later, they actually have one of the highest gross profit margins and net profit margins in their industry. We like to see companies keep their costs low, and their selling, general, and administrative expenses being 64%, which is less than our threshold of 80%, shows this. We also like to see a company that does not need research and development to be successful. This is because if the company can't come out with the next big thing, their products will no longer be in use. C.H. Robinson does not have any R&D, so that's good for us. As of the last audited statement, C.H. Robinson did not have any bonds, so we don't have any interest percent of operating profit. The obligation ratio shows us how liquid a company is by telling us how long it would take them to pay off their debt. This is important because when credit runs dry, a company needs to be self-financing so that they can support themselves. C.H. Robinson shows us that they have this quality by being able to pay off their debt in a little under 1.5 years. The current ratio is also a liquidity ratio, showing us how well their short-term assets are able to pay off their short-term liabilities. With the current ratio being 1.34, that meets our threshold of greater than 1. Guru finds C.H. Robinson to be predictable, which is good because if a company isn't predictable, then how can you value it? Value Line also thinks C.H. Robinson is predictable as well as financially strong. C.H. Robinson is a non-asset-based third-party logistics company, but what their return on assets shows us that is even with the few amount of assets they have, they are able to get good returns, showing us how efficient they are. Their return on assets have a general upward trend for the past 10 years. C.H. Return on equity shows us how well the company is using shareholder wealth to create net income. And as you can see here, C.H. Robinson has met our 15% threshold for the last 10 years, and there is an upward trend. Return on capital is like return on equity, except it adds in long-term debt to the denominator. This explains the difference between return on equity and return on capital for the trailing 12-month period, but you can see here that return on capital still meets our threshold of 15%, and there is an increasing trend. The DuPont analysis breaks return on equity into 3 segments. The first one is the net profit margin, which shows how efficient a company is with operations. The next one is total asset turnover, which tells us how efficiently they're using their assets. And then the last one is financial leverage multiplier, which shows us how much debt is influencing their return on equity. As you can see, their net profit margin is high, their total asset turnover is high, and their financial leverage multiplier doesn't really have a big effect on ROE. In fact, if their financial leverage multiplier was 1, meaning they had no debt, their return on equity would still be above 20%. Retained earnings is how much a company has left over of net income after they pay out their dividends. This is important because a company can use this to pay off their debt or to reinvest in themselves. Over the past 10 years, C.H. Robinson's retained earnings has increased 5-fold. Free cash flow per share has also had an upward trend over the past 10 years. And if you take out 2008, it's even more consistent. Free cash flow is important because it's a metric that cannot be manipulated by accounting principles. Since 2006, C.H. Robinson's shares outstanding have been on a decline. And over the past 7 years, they have bought back 10% of their shares. Recently, they have made an announcement that they will be having more share buybacks. So we can expect them to continue buying back their shares. And this is important because it increases our stake in the company, and we don't have to deal with the tax consequences of dividends. And now Leon will talk about the investment checklist.
All right, so here what we're looking at is just a few trends from the company. As you can see, all the green is good and the red is bad. We have a whole lot of green here. What I'm talking about is gross profit margin, operating profit margin, and net profit margin. And these are 3 of our reds here. We're not really concerned about these because a very large part of C.H. Robinson's growth is due to acquisitions. And when you acquire a company, you can expect a slight decrease in margins due to the merging of 2 different operating entities. If you have, say, me and Dave both like to cook meat, we're both really good at cooking meat, and we want to hook up and cook more meat. Dave likes to smoke his meat, and I like to grill my meat. We have 2 different ways of doing it, but as we continue to work together, we'll figure out a way that works best for us and become more efficient at selling our finished products. So this isn't a trend that we expect to continue. We will expect our margins to get better as companies learn how to work better together. Long-term debt has been increasing, or has increased recently, just because C.H. Robin has got $500 million in revolving door credit. This is coming up from no long-term debt, so this isn't really something we're very worried about. And when we look at some more competitive advantage things, this business is very easy to explain. They help people move things from where they have their products to where their products need to be. It's not heavily unionized. It doesn't require very much capital. It doesn't require any research and development. Inventory cannot become obsolete except for the produce that we do offer. There's no chronic one-time write-offs. However, there was a one-time gain in the sale of the T-check, which happened in 2012. The company can raise its prices to offset inflation, assuming that inflation is not due to oil costs. We assume that everyone is going to continue to be needing their products at where they need to be sold, so there's always going to be a need to have things move from place to place. Give me $1 billion, I couldn't really build a competitor to C.H. Robinson, even though there is a very low barrier of entry in the shipping industry. We looked at Morningstar debt timing. They don't have any information on C.H. Robinson's debt because they don't really have any long-term debt other than a $500 million revolving door credit. But we did a little digging, we looked in the 10Q, and found $350 million in payable notes. And we have $175 million of that due in 2023, 155 years later in 2028, 175 million 5 years after that in 2033. This is good spacing. We like to see this. They're taking advantage of low interest rates right now and locking in. This is a good time to be acquiring debt if you want to. And now we're going to take a look at the conscious investor reports. Basically what we're doing here is we're putting in 6 years of numbers to give us a historical growth rate along with a stability rating. And we're using these numbers to project how we think the company will do further on down the road. So we have a price of $59.13, which has gone down since we run these numbers. So our numbers will look even better than this with the new price. Earnings per share is at 2.77, and this is an augmented earnings per share because we took out the T-check sale in order to get a more realistic look at how we expect C.H. Robinson to perform in the future going forward. The earnings per share that's in the 10K is about 3.67. The price earnings ratio is at 26.45. Historical growth rate of 8.26%, payout rate of 44%. That'll give us an annualized rate of return of 14.88%. And now we're gonna play a little bit safer, knock down some of these numbers and see where we're at. So we're cutting PE by 47%, we're cutting payout ratio by 60%, and that gives us an annualized rate of return of 2.07%. We're still making money with this investment. Now we're gonna take it down to a break even and see what it looks like for us to not have to make any money. We cut the PE by over 50%, cut growth again by 11%, cut payout by another 16%. That gives us an annualized rate of return of 0. Now these numbers are numbers that C.H. Robinson hasn't gotten us down to in the last 10, 15 years. Now Arthur's going to talk to you about why now is the time to invest.
So Leah just talked about what we had to make the company look like for this to be considered a kind of a break-even or fair value purchase right now. What I'm going to do now is I'm going to look at where we've been historically to C.H. Robinson. Again, like Leon said, I look and they put green is good, red is not so much good. So what we're looking at is where we stand in valuations. You're going to see our price to earnings is going to change on the next slide. This is using the $2.77 earnings. That was without the T-checks. The next slide is going to go on the earnings that they reported to with SEC. We just wanted to show that either way, it was still in a very good color, and either way, it's still, that's not a reason to not invest in the company, is what we're trying to say. The next slide will show it a little more easier. What we're seeing is that I took, outside of this quarter, outside of the trailing 12 months, I took the minimum, the average, and the maximum of what we've been trading at the last 10 years. I then placed the current ratios next to it. What you'll see, price to earnings, price to sales, enterprise value, and Schiller PE are all lower than they've ever been in the past 10 years. What we're seeing is a shift of investments, of the type of investors, from momentum-based investors to an opportunity for true value investors, which is what we're trying to capitalize on. Free price to free cash flow is closer to the average, yet still not concerning because it's actually below the average. The forward rate of return, same thing as price to free cash flow. As I'm sure Dave and maybe a few of you guys are noticing, it's price to tangible book is omitted from here. The reason, it's a non-asset-based third-party company that just issued some debt. Their price to tangible book was not really meaningful in its valuation right now, and so we omitted it because it was the first time that it had a debt, and compared to how much assets it has on the book, it was not a meaningful number, and that's not the reason to or not to invest into a company like this. Next, we're going to compare it against some of its competitors. The second and third column are show UPS and FedEx. Those are asset-based logistic companies. And what you're going to see immediately notice is that they have much lower margins. And on the far right, we have an XPO logistics company that I'm sure Dave wrote down when we asked if we could have a billion-dollar competitor. And the reason why we feel confident that that's not the case is because, again, our size and our scope and our technology. But just to kind of look at what we're trading at, C.H. Robinson is trading at a low price to earnings, price to sales compared to its industry. It's a good time to invest. Their ROE and their ROA are both higher than the industry average over here. We talked about the operating and the net profit margin did not meet Buffett's standards, but neither does Walmart. That's not necessarily a reason to throw out a company. What you need to look for is how it's competing in the industry. Is it an industry leader? In which case, C.H. Robinson is. It's more efficient than any other company that we've been able to look at and identify. Its 10-year and 1-year growth rate are the highest of these 4 competitors. You can see that the 5-year growth rate is FedEx. That's the leader in that one. That would be a cause for concern until you realize that 5 years ago we were in 2008. If FedEx grew at 83% in those 5 years, that probably tells me more of where FedEx was 5 years ago, more so than where it's going now in the future. So that's something that we're not concerned about again. And we have a healthy growth rate of 14.4. Stephanie clearly showed you the free cash flow per share in 2008 was some of our highest that we've had. So when we talk about economic recessions, yes, that's a concern, because if we have something so catastrophic or such a macro event that takes out the entire US, then yes, that's something that we need to be worried about. But again, we're hedged against all across the world, and we strive in recessionary periods. Next, one of the things we do is, as investors, and as anybody that makes a decision, is we have to make our decisions on the margin. Where is the best place to put that next dollar? Clearly, our portfolio has companies that we've identified as either great values or ideal Buffett companies. In fact, C.H. Robinson's already in our portfolio for these very reasons. So I'm going to compare to where it's trading at today against where it's been trading, or against other investments in our portfolio to see how that compares, why we chose C.H. Robinson versus anything else in our portfolio. Price to sales, as Ernie mentioned, AIG warrants don't have sales. It's a contract that allows you to buy AIG, so that's kind of omitted from what we're looking at. But you can see C.H. Robinson is near the top in price to sales. Everything else being equal, a lower price to sales suggests a higher value at the right now for the company. Next, we look at return on equity. As we've said, it's Buffett's favorite ratio. And the reason why is because it tells Warren Buffett how much net income the company's able to generate with shareholder wealth. As you can see, C.H. Robinson does this better than any other company currently in our portfolio. Quick ratio. It's very similar to the current ratio, but it subtracts out inventory, just kind of to give an idea of how liquid a company can be if it needs to be. One of the things we talked about is, again, you don't want to be an illiquid company. You can have tons of assets on your books, but if you don't have the cash to pay your debtors, the second you miss a payment, you will find yourself in bankruptcy court. As a shareholder, that is not something you ever want to see. It's not a problem for us. Return on assets. We've talked about this a few times. C.H. Robinson is has the second highest return on assets in our portfolio currently. And again, it just shows how well we're able to utilize our assets to generate income for our shareholders. I know we're going kind of quick, but I also know the first group went a little late, so we're just going to kind of conclude with C.H. Robinson. We have a 7-point checklist that we're going to go through, and this is what Buffett put forward, and kind of identifying where and how to evaluate a company. First thing, is it a simple business? Buffett's famous for his biggest investments being in Johnson & Johnson, Coca-Cola, and companies like that. Companies that are just the backbone of America and are very easy to understand. C.H. Robinson is that. It's a third-party, non-asset-based logistics. It pairs shippers and suppliers with each other to increase efficiencies in the trucking, shipping, and air industry. Does that favor long-term prospects? We've shown that it's grown huge amounts in the ocean, on water, and in air. They are the largest third-party logistics company in North America. However, they represent a very small part of the market share when you compare it to the entire aggregate. Additionally, there's lots of places to grow overseas. I'm going to show that we have multiple offices. We just opened an office in Austria 3 days ago. So that's something that we're really excited to see. It makes innovations a little easier. Again, when we have these kind of like decentralized management structure that we have at C.H. Robinson, then we allow our managers to do what they feel is best in any area of the world that they see fit. So we're very bullish in the long-term prospects. Next, able and honest management. The current executive team has an average age of 47 years old. They've been with the company for 22 years on average. Almost half their life. What this tells us is C.H. Robinson takes care of its management, and the management takes care of its shareholders. They just approved that share buyback program for the shareholders. So what we're seeing is this is a young management team that clearly stays with this company. And it's something that we can count on 10, 15, 20 years down the road. And we don't have to worry about some new management team coming in and trying to fix C.H. Robinson when there's clearly nothing wrong with it. Next, we look at consistent earnings. Again, you need to have something predictable. You have to be able to value a company to some kind of level of consistency. Free cash flow per share, revenues per share have all steadily increased. What we're looking for is as we continue to make acquisitions, we want an integration of the net profits and the operating margins, which is what we've seen. So we have no doubt that they're going to have consistent earnings in the past and that we're going to continue to be able to do that in the future. Again, it seems like we've talked about this a couple times, the return on equity. Again, that's Buffett's favorite metric. Even our return on capital, as Stephanie pointed out, is above 15% threshold. As Stephanie pointed out, even if we remove the financial leverage multiplier on our DuPont analysis, we're still over 20%. So well above our 15% threshold as far as returning net income to shareholders, which is something that any great company should be able to do. Little debt. Debt has been, Dave always says, is the greatest failures in history, whether it be in businesses, our countries, or anything you look at, are due to too much debt. Debt does not make you right or wrong, it merely amplifies the degree to which you are right or wrong. So C.H. Robinson has no problem taking on a little bit more debt because we had none. So that's something that we're not really worried about. But as we showed, they can still pay it off in less than 1.5 years, so they're still a highly liquid company and they don't have to worry about too much debt becoming a problem anytime soon. And then finally, is now the time to invest. For it to be a true value investment, there needs to be a value gap and a spread between what we think a fair value would be and where it's trading at right now. We've showed that in the past 10 years, C.H. Robinson has never traded lower in price to earnings, price to sales, enterprise value, and Schiller PE. These are all things that make us as value investors very excited and very hopeful for the opportunity which we see going forward. For that reason, our recommendation is to write an in-the-money put with a strike price of $60 per share and a limit of $3 per contract with an expiration of February 22nd of the which will be in a little over 3 weeks. What this will do is effectively lower our entry point to $57 a share, and we'll collect that $3 per share premium up front. If that put is never triggered, we'll see an annualized rate of return greater than 84%. So, and again, we would just re-enter another put. We'll take that every day of the week as value investors. So I want to thank you for your time, and on behalf of Not So Risky Business, we welcome any questions from the judges of the audience.
Nathan, you said that C.H. Robinson is a non-asset-based third-party logistics company. What does that mean, and is it good or bad? Can you re-emphasize that?
Like what they have, they don't really have any trucks or other equipment. Most of their assets, I guess, would be land and offices, buildings like that.
So who would be a asset-based?
Oh, something like UPS. They have their trucks.
Rightfully so, you said that recession is a risk. But what did C.H. Robinson, as a non-asset-based provider, do during the recession? What were they able to achieve?
They grew.
How so?
They did very well in the recession.
Do you know why that is? The earnings and dividends grew during the recession. Do you know why they were able to accomplish that?
Because when there's a recession, people are not necessarily buying things, but they're still going to transport things because whether there's a recession or not, people need to eat. So there's going to be cans on the shelves in Walmart. They're going to be selling hot dogs. Steaks going to be smoked as meat. But I mean, things like that are still going to be going places, and those are more perishable things.
Moreover, I imagine there'd be an increased hesitancy to invest in your own trucks, so maybe that opened up the market to find something like C.H. Robinson so they can easily pair and find existing trucks. Additionally, if you're in a recession, times are tight, you need to increase your efficiency, give C.H. Robinson a call.
So, still on that non-asset note, Arthur, you compared C.H. Robinson to companies like UPS and FedEx up on your analysis. Why didn't you compare them to something like Expeditors or Landstar?
Because it's still a logistics market, and they exist in that market, and they're real competitors to what C.H. Robinson does and what they hope to do going forward.
Correct, and I'm not disagreeing with you that they are competitors, but those were non-asset-based competitors, and if you stack them up next to each other, you'd actually see that Expeditors and Landstar have higher margins. So, as someone that is a potential consider. And so you make the claim that C.H. Robinson has the best. And yes, compared to the asset base, they obviously do, but maybe an expedited claim starter is a valid consideration.
Y'all mentioned that the trucking segment makes up the largest portion of C.H. Robinson's revenue. Which of the modes or which of the segments are growing the fastest for the company?
That would be ocean and air. I kind of touched on numbers earlier and got nervous and said the wrong numbers. But ocean has grown. I really want to see here. Ocean has grown 150% in the past.
Year over year. Year over
Yeah,
year.
every year. And then the airways, air cargo has grown 80%. So those are rapidly expanding. Trucking is still, as you can see, 3/4 of it.
And add on to that, a big part of the increase in the ocean has been the acquisition of fees.
So with those acquisitions, are these numbers from 2012, and how do you expect those acquisitions to affect their revenue mix and their net income mix?
These numbers are from the latest annual report, that is 2012.
How do you expect the acquisitions that they made in 2012? So 2012 won't have the latest numbers from those acquisitions. How do you expect those to affect this mix?
From a pure pie basis, we expect our ocean and our air to be a little bit larger.
Sure.
I mean, like,
Expect that to continue?
yeah,
Trucking
I'm not
less-
projecting 150 from now until perpetuity, but I mean, that'd be nice if that was the case. But yeah, I do expect it to continue to increase. And C.H. Robinson, again, part of the reason they took out our revolving door credit is so they continue to be very aggressive in the acquisition field.
And they actually did state that is one of their long-term goals. They want to grow at least 15% of their parent company in the long term. So these are expected.
Okay. Emily, you talked about how the company has a decentralized organization. Can you just explain this further and why it's an advantage or disadvantage?
It's decentralized. Can you go to the slide with the world on it? The beautiful world we live in. It's decentralized, so it has major offices in these different areas. I mean, these four are the big offices: Chicago, Amsterdam, Mumbai, Shanghai. But one of the reasons that this is such a good thing is, as Arthur actually pointed out earlier, if something really drastic happens and zombies take over North America or something, we can still make revenues and from the 14 offices in Europe. About not too long ago, so it seemed fairly.
And one of the decentralized management allows every single management team. The way you do business in China and the way you do business in South America are not the exact same ways. But having a decentralized merit-based kind of structure and this, where how we tie this into compensation is we allow we hire competent managers, as we say, executives alone, we're looking at an average time of 22 years of the company, so almost half their lives. So we're hiring able management, and we're empowering them to make what they feel is the best decision for their region, and we found that to be very successful.
And different cultures play a huge role in the way that you approach these things. So how they do business in Asia is not how we would approach business in America.
Just one more question. You guys were showing 10-year, 5-year, and 1-year growth rates for C.H. Robinson. So you already stated that the company is shifting from a momentum or a growth stock to a value stock. So are we expecting lower growth? And Emily, you stated that management, their goal for growth in the past has been 15%. What are their goals going forward, and what do you guys really expect? How do you expect the company to grow going forward?
That actually is the future goal. It's on one of the next slides. So, can you take this? You want to take it?
Basically, their long-term goal is to grow at 15%. Not like stop, I guess.
As value investors, we're seeing a huge shift to shareholder value, and we're seeing these share buyback programs. So to say we're going net revenues, I know what you're talking about. They talk about the shifting downward, and it depends on really what section. They really break it down as to we hope to grow airlines in Asia by 15 to 20%, and we hope to grow truck industry in America by 5 to 7%. So I don't have an aggregate for you as far as what they hope to do going forward, But if we're talking about net revenues, we can grow net revenues slower than 15%, and with share buybacks and with dividends, as shareholders, we can still see a healthy return on that investment.
The biggest portion of that is that they want to focus on their customers, and that is the most important part of their growth. It's all focused on the customer and their relationship with the supplier.
Okay, I've got several questions. I'll try to ask them one at a time. In your presentation, you noted technology both as a risk factor and as a competitive advantage. So from your perspective, is it right on the fence, or is it more of an advantage or more of a risk for them?
Definitely more of an advantage because C.H. Robinson does have an atmosphere, and if you're a mom and pop shop, if you're having your own trucking company, you're not going to be able to invest in the software that C.H. Robinson can easily invest in. So your average cost is just going to be spread out. At C.H. Robinson, you can spread out that average cost and mitigate it to a very, very low on the margin cost. We recognize that it's a risk just in the fact that if somebody else were to come out with something just monumentally better than Navisphere, which again, C.H. Robinson has a well-established position in North America and the world itself, so we don't really forecast that happening. But if something were to come out like that, then anytime you deal with technology, a risk of innovation and not being the innovative leader at that exact moment is a real risk. But I mean, even if that were to happen, the customers that we have, our top 500 customers make up 50% of our revenues. So I mean, it's unlikely that those customers would all flood out. Those customers are well established and easy to find for us.
Along those lines then, given that they don't have any R&D expense, I'm assuming that they acquired Navisphere. So did you see any commentary from the company on how they think maintaining that software over time, is that going to have a positive marginal effect for them in their operating margins? Or do you have a feel for how much control they have over that software now that they own it? So is that a risk factor for them to stay competitive?
Yes.
As far as the revolving credit goes, was there any explicit reasoning for why that's popped up?
Again, I read some of the other doing a large thing about acquisitions in the future. Those reasons, again, we talked about interest rates being a historical low. We're going to see the Fed just announced another tapering of $10 billion monthly. So we can see interest rates expect to rise, although the Fed promises short-term interest rates will remain low. Long-term interest rates, which similar will be locked in, going from 2000 all the way to 2033, I believe, will be low. So if you're going to make a long-term investment with hopes and goals of making lots of acquisitions in the near or even somewhat distant future, now would be the time to take up that credit.
With them being a non-asset broker, as part of their core revenue model, they're brokering this transportation. They're receiving a fee for getting the carrier with the shipper, right? So given that, how much exposure, there was a comment in here about oil prices, and how much exposure do they have to oil and carrier prices if they're brokering? In other words, is it going to eat into their margins if carrier prices go up, or are the customers out there still going to need a good logistics partner regardless of what the market price is?
What? Can you ask me a question?
answer your question. The second one is true. I mean, just looking at the logistics company, but that's when we talk about offsetting inflation and whether the very real fact that there's if people are in business with costs are being driven up, there's only so much of they're going to try to pass some of that on us, and we're aware of that. But I mean, there's still going to be a logistics company. But whether or not we can just merit any price in the world, again, that's why we made that kind of notation that oil is kind of an exception to what we're doing in terms of a macro inflationary policy.
Okay, so just to clarify that a little bit, when you're looking at this company and you're reading what management's telling you, they're saying that this year we charge $5 to get them the best price. Next year we're going to charge them $5 to get the best price. But if oil prices go way up, we may have to charge $4.95 because.
What we're saying is we don't want to risk alienating any of our customers. And so, I mean, if that means the difference between having like a shrinking our customer base, then that's something we don't want to pursue.
Do you feel like the current emerging market doubt is having an effect on the share price?
Yeah, I mean, anytime we talk about these developing countries and what they're doing going forward, there's a lot of hesitation, and obviously all the news you turn on right now, that's part of the reason why the markets has been down. That's part of the reason the market's been going down is this hesitancy in investing very heavily in emerging markets. But that's not something that we see as a fundamental shift in the global economic climate. To say that to bet against every single emerging country is a bet that we'll take the other side of. If you're asking me, like, if that's an issue, and that's something that we can capitalize as they begin to grow and as they begin to develop and demand more infrastructure, that's a hole that we can fill.
So you feel like part of their moat is that as parts of the lows are slowing down, they can redouble their efforts in other areas, kind of keep on trucking or
I enjoy the pun, Andrew, but yeah. Yes, I mean, that's a true statement. What we're talking about is global dominance, is an ability to spread globally. It's something that, again, by having these management structures and having like kind of corporate headquarters all around the world, decentralized management, that's an opportunity that will not have high costs for us to get into, as opposed to what some other logistics companies may see.
So you guys said multiple times in your presentation that you have decentralized offices, and that allowed them to avert the zombie apocalypse from overwhelming them. I also understand that these are run as independent profit centers, and that helps to keep them motivated to keep growing the company. What keeps the individual profit centers from competing against each other and cannibalizing market share within the same company?
Within those decentralized locations, there's open lines of communication. Sometimes we can collaborate with each other in order to keep the trucks full, get them there in the most efficient way possible. There's a center in Chicago, there's a center in Minneapolis, and there's something that's passing through there. Those two branches will let each other know. Say, hey, we have a truck that's making stop in Chicago. Can you help us to find something to fill up our truck in Chicago so that we're not losing money on our way through Minneapolis?
Now, I could be wrong on the exact number, but it's somewhere near 40% of these transactions that occur are actually from recommendations of other locations.
Okay. In the economic cycle, you've got expansion, stability, and contraction. Where does C.H. Robinson do the best, and where do they do the worst?
They do the worst in a stable market. If they're expanding, then there's going to be a greater demand for goods and services, and we already talked a little bit about recessionaries and what it looked like there. So a stable, steady, perfect economy is the economy that we need to avoid. We've done a pretty good job so far.
Well, as long as our government stays in power, you stated that they had able and honest management, and you quantified that by stating their young ages, but yet the tenure with the firm. What does somebody's age have to do with being able or honest?
They're going to be there in management for the next foreseeable 15 to 20 years. So we're going to have the
you stated a couple points in the presentation that it was attractive right now because of the price to sales ratio. Why is the price to sales ratio an effective metric for evaluating C.H. Robinson as compared to some other company? Is that the most effective way of figuring out that this is a cheap company? And is that the same with all other companies? I mean, would you value Microsoft the same way or Apple Computer the same way?
Considering the low margin industry, I mean, you obviously can't value Microsoft the same way because it turns into different earnings. With a low market industry, again, you would see the other leaders in price of sales were Walmart. So it's this low margin industry that we value what the sales are and give us a realistic idea of where they're going and where they are right now.
So you guys mentioned that they have started taking on debt and they're expanding it out from a revolving line of credit out to 3 different tranches of debt coming due over, the next 20 years or so. And you explained that return on capital is different than return on equity. Explain to me what those 2 different metrics are doing.
Return on equity is measuring how much net income a company can generate using their shareholder wealth. Return on capital is like return on equity, except it has long-term debt added to the shareholder wealth. So,
I mean, one of the ways is you can choose return on equity is by increasing your financial leverage multiplier. So when we look at return on capital, we're looking at without all that extra leverage.
Okay. You mentioned that C.H. Robinson competes in a very fragmented industry. What is their market share of the local trucking industry?
Yes.
Okay. Do you guys really believe that free cash flow cannot be manipulated? That was stated.
It's much more difficult to manipulate than earnings, and I'll take free cash flow every day of earnings.
And I will accept that it is more difficult to manipulate as opposed to it can never be manipulated. Nate, John, other questions?
Sure. You guys kind of kept going over the fact that C.H. Robinson has this moat, and they have a competitive advantage, and you can't build a competitor with $1 billion. So why have the company's gross operating and net margins been in decline over the last 5 years? If they don't have, and you also mentioned it's fragmented, and they seem to have a lot of competitors. So if they're able to rise above these other competitors, why have their margins been in decline?
Like I talked about with the margins, the reason they are in decline or have been coming down is due to the acquisitions that they've been making. Once you add a new company into C.H. Robinson, it takes a little while for those 2 companies to figure out exactly how they're going to fit together and how they're going to run most efficiently.
Good. Appreciate it. Why don't we give them a big round of applause? All right. Well, thank you for everybody staying till 7 o'clock on a Friday night. Only feels like it's already Saturday night. You guys are all to be commended in your support of these students who I think have done a phenomenal job. When I think about my own maturity level at that age, it just pales in comparison. So that said, thank you for being here and thank you for your support. Our winner is The IBM group. However, C.H. Robinson, you guys did a fantastic job too. So of the money that's been donated, $5,000 will go to fund scholarships this semester for the winning team, $3,000 to C.H. Robinson team, and $2,000 to Melanie Thompson's business department. Yay! Thank you everybody for being here. I hope that I'll see everybody next year too. Y'all have a great weekend.
Students at TLU engage in high-impact educational experiences that include civic engagement, aesthetic expression, critical thinking, and a focus on intercultural knowledge in a community that welcomes the interplay of faith and reason.